Okay, perfect. Hello, everyone, and welcome to today's webinar on the investment opportunities and challenges in Asian markets, brought to you by Continental. My name is Anselm Mendes, and I'm the Executive Director Sales with Continental. I look after growing sales and distribution for the company, and I'm passionate about development, sales, marketing, and technology, specifically artificial intelligence and blockchain. At the very outset, thank you for joining us for today's session, where we take a look at a subject and a destination, both of which are incredibly fascinating. To help us make sense of the subject at hand, we are glad to have with us our three panelists for today, and I will start by introducing them to you. Please join me in welcoming Ms. Dion Chung. Dion is the Associate Investment Director Asia ex-Japan for Schroders since August 2019. Prior to joining Schroders, she was a product specialist with HSBC Global Asset Management. Dion also worked as a sell-side equity analyst with Quam Securities before transferring over to Quam Asset Management as a buy-side equity analyst. Earlier in her career, she was an assistant audit manager at KPMG, and Dion graduated with a bachelor's from the Hong Kong Baptist University and is a certified public accountant. Welcome, Dion, and thank you for joining us.
Hi, everyone.
Hi. Next, we have with us Ms. Lakshmi Iyer, Chief Investment Officer, Debt, and Head of Products for Kotak Mahindra Asset Management Company. Ms. Lakshmi has been with Kotak Mahindra with the Kotak Mahindra Group for 21 years now. And prior to joining the Kotak Mahindra Group, Lakshmi worked at Credence Analytics, handling debt research and financial software development. Ms. Iyer joined Kotak's fund management team in 1999 on the debt side, managing all debt schemes for them. And in 2006, she moved on to head the product function for all asset classes and has since been responsible for a lot of their product initiatives. Ms. Iyer currently heads the fixed income and product team for Kotak Mahindra. Welcome, Lakshmi. Thank you for joining us today.
Thanks a lot, and pleasure to be addressing all of you today. Thank you so much.
Thank you. Please also welcome our very own Ms. Neelam Verma, who is the Vice President and Head of Investments at the Continental Group. Neelam is a seasoned finance and banking professional with 20 plus years of experience across investments, private banking, wealth management, corporate and commercial banking, to name a few, both across India and the UAE. She holds an MBA Finance from New Hampshire University and is an advanced strategic management expert from IIM Ahmedabad. She also holds a mini MBA from Harvard Business School and is a certified wealth manager from the American Academy of Financial Management and an international certified wealth manager from CISI UK. Her career covers working in multiple senior positions across global, international, and local banks like Citi, HDFC, First Abu Dhabi Bank, ADCB, Commercial Bank of Dubai, to name a few. Welcome, Neelam, and thank you for joining us today.
Thank you so much, Anselm. Hello, everyone.
All right, before we get to the subject at hand, a bit of housekeeping. This webinar is due to last about 60 minutes. If at any point you get disconnected, you can click on the link you received to rejoin. We will have this session available as a recording on our social channels, on LinkedIn, on Facebook, and YouTube as well. We welcome you to revisit the content yourself and share it with your family, friends, and colleagues. We also invite your comments and questions. Please have a look at the Q&A chat box. By now, each and every one of you should be an expert in video conferencing and webinars. So there's a Q&A chat box which is available on your screen. If you think of a question for the panelist at any point of time, please type it in there, and we will ask a panelist to address it during the Q&A session, which is towards the latter half of this webinar. We also do note that in order to remain on topic, we will only be taking questions relevant to the webinar subject. So if you have any specific questions related to a policy or a specific product or a company, while we may not be able to answer that in this forum, one of our team members will be in touch with you post the webinar to address your query. And to kick things off, we've got a question for you. So it's a poll question, and that should be coming up on screen. ESG. Do you think ESG is a trending choice in Asia? So we'd like to, obviously, there are two options, simple, easy, click on one of them, vote, and we'll take a look at the results in a short second. There we go. All right, now for the fun part. Our topic for today's discussion, investment opportunities and challenges in the Asian markets. In the past year, we've seen global markets reflate, post COVID-19 and do quite well. And Asian markets seem to be leading the way both economically as well as in terms of market performance. The pandemic seemed to have accelerated the shift to Asia. But with the shock of new COVID waves in India, China, and there seem to be challenges and risks that are there on the horizon. So if we can get our panelists to give us their views on the current scenario and what impact do we expect to see going forward. And we'll go to you, Neelam, to start things off.
Thank you, Anselm. Yes, it's been a challenge over the last few years, and now particularly with the COVID situation. Asia Pac, anyways, has become a region in many ways and has been known to be the engine of growth for the world's economy. It's particularly true of China, which has risen to global prominence over the last 2 decades. Although China and Japan make up more than half of the MSCI Asia Pac index, which is majorly followed worldwide, India is predicted to become the 3rd largest economy in the index by 2030. I think while many will think about Asia as a market focused only on growth, it's also a great place for income investors, as the dividend culture is very firmly ingrained in many of the countries across Asia. Talking about the pandemic, I think Asian economies have not suffered as much as the UK, Europe, or US have suffered, as Asian governments did not have much to intervene to protect jobs, to protect industries to the same extent as possibly their Western counterparts did. Also, they've done a relatively good job of containing COVID. And as such, there has been much less economic scarring, given the fact that there was a surprise emergence of the Delta variant. The Delta variant has actually spooked most of the economies across. When everyone felt that COVID is actually on the decline, we actually saw a new variant come in, which was uncalled for. All said, I think the devastating effects that COVID has had, it has also been a game changer in the Asia Pac region. One of the reasons is that it has accelerated the digitization of the region, particularly the less tech-savvy parts of Asia, where we saw the SARS epidemic in 2003 acting as a catalyst for certain Chinese companies. I think Alibaba was one of the biggest winners there. COVID-19 has boosted e-commerce across the Southern East Asia, which has predominantly been a face-to-face buyer's market, a cash transaction-driven market. I'm talking about China and India both here. India is growing quickly. A manufacturing push that the government is doing now should see it become the 3rd largest global economy by 2030. And it was also the first major economy which was impacted by the Delta variant. A lot of times it says that Delta variant emerged in India, which a lot of people debate. But yeah, it was the first economy. And it was also the first economy which was out of this. It emerged out of the Delta variant, the impact on the economic growth. However, with the talk of the 3rd wave coming, the occurrence of sustained pickup in the recovery remains to be seen. So that's my take on the broader sense in terms of what Asia has to offer. A lot more conversation will happen through the webinar. Thank you.
Of course. And thank you for that. I think some very interesting points that you raised, and we've seen that play out. And we go to Lakshmi. Lakshmi, how are you seeing this play out? I mean, what's your take on overall the scenario and the things that are going on?
Sure, so there is always a filmy in me, there's always a poet in me. So if I try to summarize this situation in the form of a limerick, what comes to mind is that basically central bankers running a printing press and global debt at record high, yet yields are under no big stress. Liquidity is going into financial assets, which probably could be a potential source of an inflation threat. Global market caps are soaring, and most equity indices are roaring. The pandemic 3 wave looks threatening at times, but markets just don't seem to be in a mood to chime. While gold has lived its role as a safe haven metal, I would say time will tell how this scenario will settle. So that, in some sense, summarizes the mood that we are in today's scenario. And as Neelam said, we can unravel some more of these as we talk along.
That was a mean rap, and thank you for that. I think that was really interesting. Yes, very well made points as well. And we'll head over to Dion for her thoughts and views on the scenario that we currently see.
Yeah, thank you. Yeah, speaking of the pandemic, if you look at China, as Lilam has also mentioned, it doesn't really impact the Chinese economy. So if you look at last year in 2020, China was basically the best performing market in Asia, simply because it has been very successful in containing the pandemic. So basically, if you look at the economy, I would say that most economic activities or industrial activities are like normal. The only sector that have been impacted by the pandemic would be the travel sector, the tourism sector, where you can see sectors such as airlines, hotels, or Macau gaming industry are more impacted. Other than that, the overall economic situation in China has been holding up quite well. And also, similar to other major economies, China has been doing a lot of policies, pumping liquidities into the system to help the economy getting through this economic downturn. So far, we do not feel a lot of worries in the market about the pandemic or even the Delta variant. I know that people have been talking about that, we have the Delta variants getting into China, and it seems to us that the Chinese vaccine is not quite effective against the Delta variant. But I think if I look at the market sentiment here in Hong Kong, I do not feel that investors are particularly worried because whether or not the vaccine is effective, I think it doesn't really, it is not very important to China because China has its own way to control the virus. After all, it is a very strong government. When there is outbreak in certain cities or certain local areas, the government can basically force you to stay home and stop the virus from getting out. So that's, the Chinese culture where the government has very strong control. So going back to the market here in Asia or in China, I do not feel that the market sentiment has been driven by the pandemic situation. Apparently there are lots of other factors such as regulatory changes, the wealth redistribution talk in China. These things are more hot topic right now in the market compared to the pandemic.
I think absolutely spot on. There is a great amount of control that China exerts, and that can move quite swiftly. We've seen that happen in the past as well, and that also sort of tailing in from where you sort of ended in a sense. There are of course an interesting sort of trend that we're seeing in terms of the central banks and the roles that we're seeing them play. And if I can go to you, Lakshmi, with regard to how are you seeing that pan out? We've heard some news in the past about some of the moves that the central banks are making. Would you like to share some of your thoughts on it?
Sure. So I think at the current juncture, the central bankers world across, not just in Asia or in India, are playing the role of the goalkeeper. And what is the role of a goalkeeper? They have to prevent, the opponent from taking the maximum goals. And here, clearly, the opponent is the pandemic or the coronavirus, which is threatening to mutate itself in various forms and shapes, and probably catching anyone and everyone off guard. Whoever knew that a country like Israel, which has 80% plus vaccinated population, is actually basing itself, towards a third wave. Of course, US is another different story where the unvaccinated population is actually contracting the virus. So I think that is the role where the central banker at the initial stage just kind of foresaw a potential malnourishment in the society, in the entire economic system, and actually pumped in steroids through high-end liquidity, which is why I started off with the printing press. And that's the right thing that they would have done at that point in time, because if you let malnourishment continue for so long, it can lead into death. And in this case, it's economic death. And I think in that role, kudos to the central bankers across the world. They have done a fantastic job. Most of the economies, I would say, are limping back to normalcy. I would not say it's a V-shaped. I don't know what alphabets to quote. So my alphabet is L. I can talk about an L-shaped undertone followed by a marginal U-shaped uptick. And I think at that point in time, this role of the central banker right now should actually move into wicket keeping. So they have to ensure that from goalie, they have to morph themselves into a wicket keeper to ensure that they don't let this inflation monster actually take the entire ecosystem off guard. And I think that also is something which I alluded that with tons of money moving into financial asset classes, this asset deflation trade potentially could have itself into an inflation threat. So I think that's where the depth role of wicket keeping comes in. When you are, the batsman called inflation is actually trying to rear its ugly head over and over again, transitory or otherwise. I think time will tell. So I think that the metamorphosis, as they call, of the central banking role is exceedingly important. So I would say so far so good. Yes, I know cynics and critics will say that the central banker is behind the curve, but to every glass that is half full, there is the other person who sees it half empty. So you can't really do much.
I like how you said that, and I think that we'll keep it at that. We've got the poll responses coming in for our first poll, and if you'd like to, there you go. So yes, overwhelmingly, 78% of our audience seems to think that it is a trending choice in Asia. So more power to the companies following the ESG practices. Neelam, would you like to add something on the central bank's role in this and the way that you're seeing it pan out?
Well, I think Lakshmi summarized it very well. Every central banker today is wanting to see what next. I mean, there is new variant coming in, there is talk of third wave. They just do not know where to stop printing money. Whether it is the FOMC that we track, which is coming up with a meeting tomorrow, everyone is watching. Is there a tapering announcement coming up? Is there a tapering announcement, delay coming up? So there's just so much of information flow, which everyone is trying to comprehend, or everyone is trying to dissect. RBI trying their best to keep their dovish stance, trying to make sure that, sometimes they suck out liquidity, sometimes they just inject liquidity. There's so much happening at the same time, which is unprecedented. So, when we look at investments, we make sure that, we put into account all these things. We keep on updating our teams to, ensure that, clients know what's happening to a certain extent, while we do not know. I don't think any central banker today would want to put their money and say, okay, after 3 years, this is what is going to be the policy. Because inflation, deflation, everything is happening at the same time. I'm sure Lakshmi would resonate this. In some countries, there's a lot of inflation pressure. There's a reflation pressure happening because e-commerce companies are driving down prices of the consumer durables, consumer items, which are regulars. So there's so much happening in different parts of the world that putting across a single statement saying, what do you expect out of the central bank is going to be a big challenge.
Yeah, I think both of you seem to echo similar sentiments, and yeah, I think we can see that play out in the next few months as well. We're already seeing some of those things happen. I think earlier today or yesterday with the China central bank also putting in some of the additional liquidity into the markets. That brings us to another poll that we have for our audience, and if we can have it up on screen. We've got a few sectors for you on screen, and you can select some of those. If there are sectors other than that you think you'd look at and consider, which sectors are you most likely to invest in, you can always drop that in the message box, and we'll see if so. Please go ahead, make your choice, and we'll come back to the answers just after this next question. For our next question, I'm going to go to you, Dion, and start with something that we sort of observed from a participation perspective in the markets. We're seeing a lot more interest when it comes down to the younger generations, the newer investors coming into the markets, and we're seeing. I think part of it being driven by technology, AI, blockchain, some of the newer sort of themes that are there, NFTs, etc. driving in? What are the trends you're seeing when it comes down to the younger investors entering the market?
I think for China, it has always been a retail participant dominant market. So unlike Hong Kong or unlike the US, if you look at the Chinese equities market, it has always been dominated by retail investor. But you are right that in recent years or in the past decades, we have been seeing more and more younger people joining the investment society or investor community. That is partially because of the strong flows of information in the market that is very reasonable. But in terms of their market behavior, I do not see them being super irrational, considering that the younger generation are usually more educated. They may actually have a longer investment horizon and more analysis compared to the past generation. But speaking of the younger generation, while I do not see a very strong or special trends about how they are driving market movement, I do want to say that in China, the younger generation has been adding a lot of new energy and new trends into the country, which also affect our investment strategy and investment style. For example, if you look at the younger generation, the millennials, if you like to call them that way, they are very willing to spend money. So if you look at China, people have always been talking about consumption upgrade, and I can assure you that this trend is still continuing in China. And if you're asking me, or if you're talking about millennials who were born around year 2000, if you remember, we have that one child policy in China. China since the 1970s, and it wasn't abandoned until 2013. So the millennial, most of them are actually the single kid in the family, and that's the reason why they not only are very brave to invest, they are very willing to spend money, and they are driving the consumer market in China. And one of the very interesting point that I can share as well is that in the past, whenever people have money, they want to spend money, they are very much after those international brands or US brand or Japanese brand. But now if you talk to younger people in China, they somehow have that national pride in their blood. They are very supportive of their domestic brand, China brand. So I think it is maybe somehow related to the US-China tension, where they want to show more support to the country. And also in the past, when people talk about big, strong nation, they usually refer to the US. But today, I think a lot of younger generation in China, they feel that, well, you know what, China can be a very big country that can compete head to head to the US. So that is another key trends that we are seeing in China that actually add a lot of fuel to the domestic consumption market. And that is also the reason why some of the domestic brand has been performing very well in the equity market. So this is something that I would like to share as well. It's not just about how they are participating in the equity or the investment market. And also lastly, I think we all know that younger generation has always been very supportive of any online activities, from online shopping, online communication, online gaming, and even online banking. When you talk about how they invest in the market, apparently they are using more online platform compared to the older generation. So I think that also explains why the digitalization process in China has been so successful. And I believe no one would disagree if I said that the China's internet sector has been very successful over the past 1 to 2 decades. So these are all driven by the Gen Z or millennials generation in China.
I think some very fascinating insight and very, very valid points that you brought out, and especially some of the facts that you stated, when we consider that, makes perfect sense as to the risk appetite of the Chinese consumer, as well as the ability and what we're seeing is the domestic consumption really leading the charge for the Chinese economy. Absolutely, couldn't agree with you more. Thank you so much for that. We also got the results of our poll, and it's going to be interesting to see which sector. All right, there we go. We've got technology leading the way. I don't think there were too many surprises there at 66% of our audience feeling that that's the sector that they would like to invest in, followed by pharma, which is Actually, that's interesting. Pharma was at 24% and financial services coming in at 10%. Not too much appetite, it seems, for infrastructure or manufacturing there. But yeah, I think it's the story of the times, and we'll go to you, Lakshmi, with regard to the younger investors, the trends that you're seeing. I mean, with the Indian context, we're also seeing IPOs, and there are surges in the markets with regard to what's happening there, and it seems that the younger investors are picking up and taking note of those. So.
No, absolutely. I think I do echo Dion's sentiments. The situation is pretty similar in India. The Indian markets are on a roll. You are seeing life highs being reached on all the key indices. There is work from home. Over 7 to 8 quarters. Plus, you've seen even the millennials. Who might be in call centers and technology in. Engineering, whichever field they're all been working from home. They are flush with liquidity. They've not been pubbing, clubbing. They've not been dating outside. What do? They're not spending on girlfriends, boyfriends. So all that money is actually getting plowed into equity markets. And I'm not saying this out of gut. I'm actually saying this out of data. So, on an average, if you see 1.2 million new demat accounts were opened every month in the year 2021. I'm talking about financial year 2021, compared with just about 0.42 million per month during the previous financial year. And that's a very eye-opening, big number. So clearly, in my mind, the pandemic has accentuated the pace of the Gen Z or the millennials' participation into the capital markets. That's point number one. Point number two is, and as Dion rightly said, they're all tech savvy. I mean, my 16-year-old boy wants to dabble is the word, in equity markets. And then I have to hold him down and say that please understand the fundamentals first, and then try to get to it, which also ties into the fact that day trading or intraday trading is extremely popular among these investors, because this is the world of instant gratification. One moment when my son says IG, it has to take a second to occur to me he's talking about Instagram. So it's all about instant gratification, where you post a pic and you need instant likes, and every time you refresh to see how many likes you got. So intraday trading is getting quite popular with the users in this category. Of course, the financial awareness or the literacy has grown, and therefore you are seeing, this kind of participation. And of course, since the markets are playing ball to sentiments, it's all the herd mentality which is going in together. I wish and pray that there is a discipline when they are actually making these investments, because ETFs are also getting very popular because they're quite cost conscious also. So they are opting for relatively cheaper, avenues apart from maybe day trading and mutual fund on the active side. And therefore, as I said, going forward, and to add to it, the IPO bandwagon. I mean, that's creating it's the final icing on the cake. Where, if you just exclude maybe a handful of IPOs, pretty much most of them, at least in India, have made handsome returns for the investors. And so I think blend all this together in a jar, Anselm, and then you have your perfect recipe of how the Gen Z is actually raring to go.
Good times ahead, it seems, and especially with the younger Gen Z and millennials also participating. So that broadens so much of it for us. Neelam, what are your thoughts?
Well, I completely echo the sentiments that have been raised by Dion and Lakshmi. In the context of Indian markets, I think it's not only Indian markets, I think broadly, there's a fear of missing out, the FOMO effect that we call, which is getting into the investor's mind. You all want to ride the wave. You want to participate in the market, make those handsome returns because your friends, your family members are making all those returns, they're talking. So investments, which was basically something which was kept personal, has become more of a coffee table, dinner table discussion that, okay, do you track the markets? What's happening with the markets? Have you made money? Have you invested? So it's come to that discussion point. And this is becoming very common. Younger generation, the Gen Zs do not hide those investments that they do because they want to be known as the stars. They want to be known that, okay, I know what pick I should take today in the market. So I think they are taking on. The other thing which I would talk about in the Indian context is that the Indian IPO market is completely going into a frenzy. More than 8.5 billion plus raised till about August. And so many more IPOs to come. The unicorn companies that India has been having, I think more than 38, 39 companies, which have been in the market waiting to see, have seen this bull run. And now a lot of those companies are actually advancing their IPOs. If the current pace continues, we might have more than $12 billion worth of IPOs by the year end. It's actually becoming a great opportunity. India's fundamentals are right. The political stability is there. Overall investment policy, which is released by the finance minister time and again, makes it one of the better destinations for investors around the world, especially on the IPO side. I think it was the first time that I'm talking on behalf. I think China has been the leader in venture capital investment over the last so many years. It is the first time in this year that India has surpassed China in terms of getting venture capital investments. And we can expect a lot more IPOs coming in, whether it is from Byju's, Paytm, Oyo, Flipkart, which is managed by Walmart. So all these big names coming into the market, a lot of liquidity, a lot of positivity, despite all the Delta variants that we can think of, the waves that we can discuss. I think there are a lot of opportunities, and they look absolutely interesting when we look at from our side.
Thank you for that. And I think, I mean, we started off with, a comment that we were doing great until the second wave came across, or the third waves are coming across. But given the comments that I'm hearing from all three of you, it seems that the future indeed is very bright, and that there are plenty of opportunities that are there on the horizon. And if our audience has been listening to this webinar, it is an opportunity for them to come and participate. And I think that's a great takeaway for every member of the team. We have the next poll that is going to be up on your screen. There you go. It's on India and China and the economic growth that we're seeing. Do you think India and China will continue to offer economic growth in the next 2 to 3 years? And I think while the answer seems very obvious to me right now, it will probably give us a little bit of insight into how many of our audience members are actually listening to us. So we'll see from the responses here with them. We've got another sort of broad question for you, and I think this is going to be the last sort of broad question topic that we touch base on before we go to the audience for their questions. I can see that we've got some questions from the audience members already. And a reminder to our attendees, please do type in your questions. Like you've seen, we've got panelists that can provide you with their experience, their opinions and views that cross and provide you a very broad and wide range of expertise. So do take advantage of that. All right, coming back to you, Dion, we've got the question touched upon both India and China and being able to sort of sustain, and how long do you think that we can sustain the next year, 2 or 3 years? What's your outlook from a market perspective? If you're thinking about Asia and maybe a little more focused on India and China in the next couple of years, how do you see things playing out?
Yeah, I mean, especially for China, we have been seeing a lot of volatility in the market recently, and that is a little bit scary to a lot of international investors. So maybe I can focus on China first. So
Sure.
on a short-term view for the remaining of this year, we do feel that the volatility in the China market will continue. It will continue because there are several factors driving the volatility, and these factors are still with us. First of all, we have all the regulatory headwind. We all know that China is stepping up its regulations or controls over some industries such as internet, real estate, and education. Some people lost a lot of money from this sector in July or on a year-to-date basis. And we do not know whether or not this regulatory cycle has come to an end. We have no crystal ball. So we believe that will continue to drive market volatility. That is point number one. And secondly, I think last year, we had a slight hope that the U.S.-China trade tension could be eased a little bit after Biden, becomes the president. But so far, we are already, almost 9 months since Biden is becomes the U.S. president, and it doesn't seem to us that the situation is less intensified. I mean, the situation is still quite intensified. So I think the U.S.-China relationship, or the tension, if I should use this word, will continue to drive volatility in the market as well. And this situation, again, does not seem to be changed, or is going to change in the next few months. And I think lastly, it goes back to the policy direction. I think earlier on, we all have discussed about, central banks' policy direction. And as Lee Lam has mentioned, all the banks are struggling with what they should do next. And it is just the same in China. I mean, in the first half of this year, China seems very okay. Economic recovery is on track. People were talking about tightening, monetary tightening, interest rate increase. But entering into Q3, people started to get worried because economic recovery appeared to be slower than expected. And early July, the Chinese People Bank of China, the Chinese Central Bank, has cut the required rate of reserve, the RRR, which means that they are injecting more liquidity into the system again. And people are actually looking for even more accommodative fiscal policy into Q4 to support the GDP growth. So I think investor, similar to investor around the world, they are guessing what's next from the government. And the government is also trying to get an idea of what they should do next, because their decision would be very much depend on the economic situation, and the economic situation somehow depend on the pandemic situation. Even though I said in the beginning of the call that China is not quite impacted by the pandemic, but as a matter of fact, the sporadic outbreak in various cities in China did impact the consumption recovery in China, because people are not allowed to go out. They may spend less, and these things are actually impacting the economy. So I think if I have a short-term view, the short-term outlook for China, it should be quite volatile. And from a fundamental perspective, I mean, it should be okay. I mean, the overall economic fundamental of China has been quite strong. But the fact is that China market has performed really well last year and also in 2019. So valuation is not cheap at this level, because basically, we have 2 years of strong performance, and investors are basically pricing in a pretty strong earnings outlook for 2021 and 2022. So I think given this market backdrop, we have to be very careful when we play or navigate the China market. I think a bottom-up stock selection remains the key strategy or formula when you invest into the China market this year and next year, because there is no easy money anymore, because we have made all the easy money in 2019 and 2020. But if you're asking for a longer term view, maybe 3 years term, of course, I do feel that after the corporates deliver their earnings, after the market's valuation is being absorbed by the corporate earnings growth, when the valuations go back to a more reasonable level, I personally feel there are many more legs for the China market to go up. I mean, a lot of investors are talking about, oh, is it the end of the internet sector in China? All the sector are under regulation. Well, I mean, there are a sector that is affected by regulation. This is one of the risks whenever we invest in any emerging market. I believe everybody agrees that there is policy risk, because lots of industry are new. The policy framework is not very complete or not comprehensive. So there must be policy risk. But at the same time, there are so much new trends coming up, structural trends coming up, underpinning the growth outlook of the country. For example, we started to look at areas such as renewable energies. We have been investing a lot in electric vehicle, and because of the US-China tension, we have seen a very strong localization trend, where tech companies started to source their component or material domestically. So some upstream technology companies are benefiting. So these are just some examples of areas that we are investing. And I just want to deliver a message that in the next 1 to 2 years, it has to be very careful, because valuation is not cheap. But if you're asking for a longer term view, I do feel that there are lots of room for China to grow further. And for Asia as a whole, I do feel that we are more, biased towards the North Asia market, like Korea, Taiwan, China. Yeah, this market, because their market composition is more favorable. They have, more exposure to innovative sectors such as healthcare, technology, consumer, etc., etc. But if you look at the ASEAN market, which mainly include, for example, Thailand, Philippines, or Indonesia, they are relatively lackluster in terms of performance, because they are, first of all, they are still very much affected, struggling with the pandemic. They are still not being able to control their pandemic. That is the first point. And secondly, whenever you think about this market, it is quite hard for us to think about some interesting investment idea. Not a lot of e-commerce or healthcare or big consumer brands there. So I think for a medium-term view, we will still favor the North Asia market more compared to the Southeast Asia market.
Sure. No, thank you for that. I think
lets me to talk about the India market.
Sorry. Yeah, thank you for that. I'll head over straight away to you, Lakshmi, if you'd like to give us your view on the outlook.
Yeah, sure. So if you look at the IMF growth projections country-wise, by and large, India seems to be ruling roost. The earlier projections for 2022 financial year was under 7%. That's been upward revised to 8.5%. And as per their forecasts, China is poised to grow at 5.7%. World is, much lower at under 5%. So it's clear that it's going to be India followed by China, which are going to be the group engines going forward. As far as the monetary space is concerned in India, looks like the central banker has given enough and more support to the government, in this initiative to support the economy, but there is only limited elbow room that they can maneuver more. So it looks like the interest rates in India have bottomed out. Having said that, in terms of the FPI flows, which is a foreign portfolio flows into India, again, India clearly tops the chart. If you look at the last 12 months data, which is like August 2020 up until July 21, we've seen over $31 billion of flows into Indian shores, and that obviously is momentum based, apart from fundamental based or chasing the growth momentum, as they call. If you look at the world, market cap to GDP, again, I did a quote in my limerick that market caps are soaring and equity indices are roaring. So clearly, if you look at the world market cap to GDP, we are close to around 140%. Whereas if you look at India market cap to GDP, we're still around the 102 kind of range. And the average for India, in the last 10, 11 years has been under 80%. So therefore, from a valuation perspective, clearly we are higher end of fair value, but are we close to the absolute paranoia levels that we've seen in the past? Answer is that's not true, because India Inc. is actually reporting strong profits, buoyed by earnings, buoyed by low interest rates, and all of that put together, and of course a low base effect. So I think going forward, the outlook as far as fixed income is concerned, it's going to be chase the carry, because capital gains may be, I would say, a subservient theme as far as fixed income goes. Whereas on the equity market side, it would be more like buy the dips, because neutral does not mean exiting equities lock, stock, and barrel. It clearly means that whenever you see small corrections, you get to actually realign your portfolios. And of course, asset allocation is the king. I won't say cash is king. I would say asset allocation is king.
Absolutely, I couldn't agree more. And thank you for that. Neelam, we'll go to you for your quick comments before we go to the audience and field the questions that have been coming in thick and fast. So, yeah.
Absolutely. I think we all are learning to live with COVID-19. The pace of vaccination across countries is growing. I think this is going to give a lot of change again to the world. We see equity markets transitioning to a slower but a more sustainable, pace of gains. US, European equities remain, again, preferred destination. We view India and China equities as core holdings, but we await more attractive entry levels. And if I can say, we have a positively cautious approach. So we're very happy to buy and look at good opportunities at the right time. It's difficult to time the market, I do know, but yeah, a positively cautious approach leads us to track the markets in a nice way, allows us to look at picking up, great opportunities, select them, long-term winners, as Lakshmi and Dion said. There is so much of opportunity today available. I won't say the valuations are cheap, but yeah, at every dip we look at buying. If I have to just summarize what we can expect, we expect the global recovery to continue. Major economies are expected to achieve the herd, immunity against COVID-19 through high levels of vaccination, normal business activity to resume, growth in US and Europe to remain firmly above the pandemic level next year and the following year possibly. China becomes the only major market which is likely to have slower growth, like we talked about, though it is not going to be as low as the world growth put together. Credit cycles getting eased, which would help stabilize growth. Accommodative monetary policies in the major economies. Fiscal policy tightening. Again, we are looking forward to that to come through. Latest shift in the ECB policy to tolerate inflation about 2%. Implying that their policies which are accommodative are going to stay for longer. Current surge in inflation in the US is likely to be transitory. Again, FOMC meetings are the guiding tool. We're going to watch that closely. So equities, bonds, I think both remain a core portion of our portfolio allocations and will continue to realign as we go along. So the key here is to actively manage your portfolio, seek help of financial experts as and when required, to understand if the portfolios are rightly aligned to the risk tolerance levels, take positions, book profits, re-enter when you find good opportunities. That's all I can leave with. Thank you.
Thank you. And I think we'll go to the questions from our audience, and we'll have I think we have the poll results that we didn't get to in the midst of our conversation. There you go, it's up on screen. No surprises there. I think two people probably have contrarian views or they haven't heard us. So maybe we can have a chat later if you want. But overwhelmingly, I think there is a agreement that India and China both offer much opportunity for growth. All right, we have our first question coming up on screen, and it's an interesting one. We've spoken about this and we've touched upon central banks supporting, but what happens when they stop is the question that's come up. So what happens when the central banks stop pumping money, and what is the long-term impact of all this money being pumped into the market? I'm going to go to Lakshmi, if you'd like to take that question.
Sure. So as I said, when you are infusing fat into the system, the body gets nourished and healthy, and obviously you start consuming a lot of goods, and that goes in the health. The key thing which right now, and which is alluding to this question, is how fast are you going to go into the liposuction process? Are you going to just exhaust all the fat in one night? Then there is going to be clearly, a catastrophe waiting to implode with asset classes, going into deep correction mode, because that's the first, sign of a dehydration or malnourishment. My take is, whether it's for India or Asia or most central bankers, including the US, at least the narrative that is coming across that it is going to be gradual. There's a very interesting, article by today, by our central bank governor, Mr. Shaktikanta Das, where he talks about normalization of liquidity. And most central bankers are singing a similar song, saying that normalization does not mean draining out or sucking out of liquidity, because they are mindful of the fact that the pandemic is still in a fluid situation right now. But yes, if push comes to shove, it were to be a major tantrum, then I think markets also would end up throwing some tantrums, because the impact of a tantrum, whether it's at home or in the markets, is a lot of cacophony. So you really can't avoid that. I would still bet for the fact that it's going to be more gradual in nature rather than more abrupt in nature.
Thank you. I think I agree, and we should give them a little credit. The central bank has, and the bankers around the world have done a good job of getting us to where we are currently. We've got a next question coming up, And this, I think, would go to you, Dion. There has been talks of Chinese ADRs being delisted by the US, and recently the SEC has announced it will take a pause on approving new IPOs of Chinese companies on US stock exchanges. How likely do you think it is that the threats of delisting will come through? I know you touched upon this a bit in your when you were giving us your explanation, but if you'd like to expand and take that question, please.
Yeah, I mean, the potential delisting of ADR has always been in the market. Like we have these episodes in the past where people are talking about the forced delisting of the ADRs. And as a matter of fact, it could really happen. And what a coincidence. We feel that China is not happy about having all of its major tech companies listed in other countries. Why not Hong Kong? Why not Shanghai or Shenzhen, but the US? Of course, we know that the company owners are more after the US market for its reputation, wider ownership, more participation by international investor and institutional investor. That is the reason why tech owner would like to list their company in the US market. But as a matter of fact, it's not just that the US want to delist their ADR. We feel that China is also hoping to have these tech companies or biotech company to come back to China for their listing. And that is why I said it is a coincidence. So with or without the US driving the delisting of ADR, we will see a trend of this company coming back. And in fact, this trend is already taking place. If you look at all the tech names which have been listed or been listing in the US market, such as Alibaba, Baidu, JD.com, they have all have their secondary listing or dual listing in Hong Kong already. So I would say that from an investor perspective, it is quite safe if you are invested into stock that are already dual listing, because in case tomorrow the US is forcing you to delist your ADR, you can simply transfer your ADR into the Hong Kong shares because they are fully fungible. So this is technically, there is not an issue. But if you're investing in companies or investing in ADR that are not yet dual listed their shares in Hong Kong, then the risk could be higher. But I mean, as an investor or a professional investor, we usually do not invest in those shares, because if you are not dual listing, this is probably because you are not qualified to list it in Hong Kong. So that could also mean that you are a rather small company. So this is not usually the target investment for major international investors like Schroders. So I mean, from an investor perspective, we are not too worried about this happening, because many of the big names are already listed in Hong Kong. And we do feel that it is of mutual interest for both the US and China to have this Chinese company coming back to Asia.
Perfect, makes sense. And you need to be aware of the risks when you are looking at those kind of instruments. Completely agree. We've got our next question up on screen. And I think we'll go to Neelam for this. If one has to diversify between US, Indian, and Chinese markets, what would be the appropriate percentage of diversification?
A very interesting question. Again, it really depends on the client's risk tolerance, client's preference. We try to make sure that the asset allocations that we're doing are across both the asset classes, bonds, which is fixed income, and equities. If we have to look at the broader perspective, I would be looking at a balanced portfolio at this point. Carry equity investments, and 40% would look at fixed income space investments. And out of the 60%, probably 40 to 50% would go into US, and the rest would go into possibly more global equities, and 10 to 15% each in China and India. As I said, I think markets are all-time high. We have to be extremely cautious when we're looking at investing at this point in time. Please reach out to us if you would want to have more information on any of the underlying assets. Thank you.
Thank you. Makes sense as always. There we've got our, I think we're going to have time for maybe one or two more questions before we call this webinar to a close. In the post-pandemic era, do you think the equity flows will slow down, particularly in India, since there would be more consumer discretionary spending, along with a more neutral stance by central banks, which would reduce liquidity? That's interesting. Uh, and also, I mean, I'd sort of like to add to this that we've, in a certain sense, maybe we've seen a sort of how they say it, revenge spending, as some people like to call it. I've been cooped up and I've not been able to sort of go out and shop, and so we've seen consumers come out and try and relieve their anxiety of not being able to spend for a while. So Lakshmi, I'm going to go to you with this one and get your thoughts on this question.
The question is absolutely relevant in this market scenario where you're seeing, this gush of retail frenzy institution. I think it's firing all cylinders. But I think one needs to be extremely cognizant of the fact that India predominantly has been a traditional mindset as far as investments are concerned, where by birth you have a bank account. By birth you don't really have a demat account. So the tendency of household or retail household participation in equities has been a phenomena only maybe in the last 5 years, especially getting further entrance when demonetization happened. So I think the trend probably, if there were to be a correction, and that correction, if it sustains for long, may probably, I would say, diffuse the fence sitters, or I would say ones which are absolutely, popping pills and watching, news channels every day. Maybe for those kind of investors, there is a reason for worry. But for those who believe in longevity, for those who believe in compounding, and the fact that, their lopsidedness towards low accreting asset classes, like the traditional mode of investments, fixed deposits, or even fixed income in India, which is offering you anywhere between 3 to 5% annualized, is not exciting anymore. So I think going forward, a combination of hybrid strategies, which has equities along with fixed income, balanced advantage strategies which have equities which dynamically move in line with markets, and of course diversified equity play, and given the fact that we are talking about an anticipated 8.5% growth trajectory for India, and even if this sustains for the next 3 to 5 years, the next lever of wealth creation, there is no doubt in my mind, has to be equities. So I call the equities the Red Bull of your portfolio. It's the caffeine or the energy booster. And I call the fixed income asset class as a lemon water, which is more a stability or a refresher to your portfolio. So I don't see a massive reduction in retail flows. It might fizzle out maybe, for a temporary period, but I think that's more about form and class. I think form is temporary, class is permanent.
Thank you so much for that. And I'm just checking with the team if we have time for one more question before we wrap up, or it's time to wrap up. As I've been told, for those of you who have not seen their questions being answered, I know that there were a lot of queries and some very interesting and exciting questions. I promise you, we will get the views from Dion, from Lakshmi, and from Neelam, and have those sent across to you by email, or maybe we'll post it as a part of the chat in with the videos that we host on our social channels. So we'll make sure that we get back to you with responses to your questions. It has been an absolute pleasure having this conversation with you, and I'm sure that our audience also feels the same. We've been fortunate to have some excellent rhymes from you, Lakshmi, and some interesting insights from you, Dion, and Neelam, as always, bringing in the balance to the conversation. I'd like to extend a big thank you to you, Lakshmi, to Dion, and to Neelam for joining us today, as well as to each and every one of you attending this webinar. Thank you for your time and for your attention, and for being a part of this. And we look forward to being able to host you for many more of such webinars to come. We've got some interesting topics lined up, and even more interesting speakers and panelists that will be able to share their insight and experience with you. So take care, drive safe, and we'll see you when we see you next. Thank you.